picture this scenario for a second. You are sitting at a massive polished mahogany conference table.
Oh, yeah, the classic boardroom setup.
Right. You've got this heavy, expensive pen in your hand, and you have just signed a letter of intent to sell the business you've built from the absolute ground up.
Wow. The dream, right?
It is. I mean, you've poured years, maybe decades, of blood, sweat, and tears into this company. You've missed family dinners. You've taken out second mortgages.
Survived economic downturns.
Exactly.
Yeah.
And now, looking at the number on that piece of paper, it feels like the ultimate finish line. You're ready to pop the champagne, call your family, and just celebrate this massive payout that is finally coming your way.
But hold on.
Yeah. But I need you to put the cork back in the bottle.
Keep the champagne on ice, because that letter of intent, it is absolutely not a finish line.
That ain't close.
In the high-stakes world of mergers and acquisitions, an LOI is really merely the starting gun for the most grueling, invasive, and mentally exhausting phase of the entire transaction.
Right, the due diligence phase.
Yeah. You are about to enter a phase where outside professionals pull apart every single thing you have ever done.
And today, our deep dive is pulling from this incredibly eye-opening masterclass webinar by John F. Hendershot of Black Lake Advisory.
Yeah.
It's titled, Why Businesses Fail During Due Diligence.
It's such a crucial source.
It really is. And our mission today is to completely demystify what actually kills business deals long after that initial handshake, after the celebratory dinners, because it happens constantly.
Oh, all the time. Deals fall apart at the 11th hour every single day.
And more importantly, we are going to explore how to eliminate those threats years before a buyer ever knocks on your door. So whether you are a founder, a manager, or just someone who is fascinated by the mechanics of business strategy.
It's essential knowledge.
Definitely.
Yeah.
Okay, let's unpack this, because the reality of what buyers are truly looking for is a huge wake-up call.
The wake-up call really starts with a fundamental industry-wide misunderstanding of what due diligence even is.
How do you mean?
Well, when you talk to private business owners, a significant portion of them think due diligence is just the buyer, like reviewing the financials.
Right. They picture a couple of mild-mannered accountants sitting in a back room.
Exactly. Just making sure the math on the balance sheet adds up to the penny. But that is an incredibly naive perspective.
Right.
Due diligence is the buyer aggressively and honestly sometimes ruthlessly attempting to validate reality.
Validate reality. I like that phrasing.
Yeah, they are bringing in forensic accountants, specialized lawyers, and industry experts to answer one overarching question. Is this business truly the well-oiled machine it appears to be on the surface?
Which perfectly explains why so many owners are completely blindsided and, frankly, personally offended when the process actually starts.
They feel attacked.
Right. They feel like
Yeah.
they are being called liars.
Yeah.
And there is this core conflict that Hendershot points out in the source material, which I found brilliant. Owners constantly confuse operational familiarity with operational readiness.
What's fascinating here is that looking at it from the owner's perspective, it reveals exactly why that confusion happens.
Right.
Over the years of running a company, you build shortcuts just to survive. You figure out workarounds that eventually just become standard practice.
And you develop these verbal agreements with key vendors,
Yes.
right, or your oldest employees, where everyone just understands how it works.
Exactly. And a massive amount of your daily processes run purely on the institutional memory of a few key people.
Usually the founder.
Almost always the founder. And to the owner, that feels totally normal. It feels like hard-earned experience.
Yeah, but let's look at the buyer's perspective. I was thinking about this, and it's a lot like selling a used car.
Oh, that's a good analogy.
Think about it. Imagine you're selling your old, trusty vehicle. To start the engine, you have to jiggle the key just right, turn the steering wheel slightly to the left, and tap the dashboard twice.
We've all had a car like that.
Right. And to you, the owner who has driven it for 10 years, it's just a charming quirk. You don't even think about it anymore. It's muscle memory.
But to the person buying the car.
Exactly. To the buyer, they're looking at a broken ignition and a massive red flag.
And if you push that car analogy further, the buyer isn't just looking at the broken ignition. They are immediately factoring the cost of a mechanic into their offer price.
Yep.
And they're wondering what else is broken under the hood that they can't see yet. To a buyer, your business's charming quirks, translate directly to financial and operational risk.
Because your shortcuts equal undocumented risk.
Right. Your memory-based processes equal untransferable operations, and your verbal agreements with vendors.
Those are just unenforceable commitments.
Exactly. They could evaporate the day ownership changes hands. Buyers do not need your business to be absolutely flawless, but they absolutely require confidence. Uncertainty creates fear.
Yeah.
And as Hendershot emphasizes in the presentation, the deeper the buyer goes, the more operational truth becomes visible. Preparation is the only defense.
So when that buyer's confidence starts to shatter, what exactly is breaking it? I mean, Hendershot makes it clear that deals rarely implode over one massive catastrophic scandal.
No, it's rarely an Enron situation.
Right. It's almost always death by a thousand cuts. It's the compounding effect of small, overlapping weaknesses that slowly erode the buyer's trust.
Yeah.
The source material outlines 8 specific deal killers, and they're so interconnected. For instance, let's talk about the first major theme here, which I'll call the founder's trap.
Okay.
This encompasses a few of the deal killers from the list, namely owner dependency, lack of documentation, and weak leadership teams.
The founder's trap is arguably the most common disease in private business. It starts with owner dependency.
Right.
If the owner really is the business, if they hold all the key client relationships, if they personally negotiate every vendor contract.
If they're the chief problem solver for every minor crisis.
Exactly. Then the transition risk for a buyer is simply too high. If the owner steps away after the sale, the business might just collapse. And that dependency is almost always fueled by a lack of documentation. If your operations aren't meticulously written down, you don't actually have a replicable process.
You just have deeply ingrained habits.
Precisely.
It's like having the entire source code of a multi-million-dollar software company trapped inside one developer's head.
Yes.
If that developer leaves, the code is completely useless. And that bleeds right into the issue of weak leadership teams. I loved how Hendershot phrased this in the webinar.
Oh, the org chart thing.
Yeah. It's when you look at a company's org chart and you see a bunch of really impressive titles, VP of Operations, Director of Sales, but those people don't have any actual functional authority.
The titles are essentially decorative.
Totally.
In reality, the VP of Operations is just executing the founder's daily commands. They have to ask permission to approve a $500 expense. So when a buyer's due diligence team interviews that leadership team, it becomes painfully obvious within 5 minutes that the management layer cannot operate the company without the founder pulling the strings behind the curtain.
That's a huge red flag. Let's shift to the second major theme of deal killers, which is financial and operational fog. This is where we see financial inconsistencies and operational chaos.
Ooh, this is a big one.
Hendershot notes that a lot of brilliant entrepreneurs manage their business purely operationally. They know exactly how to manufacture the product or how to deliver an incredible service, but they don't truly understand the financial story their numbers are telling.
Yeah, they manage by looking at their bank account balance, not their financial statements.
Right.
So when a buyer's forensic accountants come in and start digging into profit margins, customer acquisition costs, or inventory turnover, the numbers don't match the story that owner has been telling.
The revenue might be there, but the underlying financial tracking is just chaotic.
And that financial fog is usually paired with operational chaos. The owner might call it normal firefighting or just, a busy Tuesday.
Right, just another day at the office.
Exactly. But when a buyer's integration team spends 60 days analyzing the business, they don't see hustle. They see systemic dysfunction. They see a company that is entirely reactive rather than proactive.
Okay, that brings us to the external and structural vulnerabilities. This covers legal and compliance exposure and customer concentration.
Yeah, customer concentration.
Wait, hold on. Let me jump in and push back on this one for a second, because this one genuinely confused me when I was reading through the sources.
Oh, really?
Yeah, customer concentration. How in the world is having a massive, incredibly loyal client a bad thing for a multi-million-dollar deal?
It sounds crazy, right?
It does.
Yeah.
I mean, if I have a whale of a client who loves us, trusts us, and gives us millions of dollars in recurring revenue every single year, shouldn't buyers be throwing money at me for securing such a great account?
On the surface, it seems totally counterintuitive. You would think a huge, reliable client is the ultimate asset.
Right.
But let's pull the specific metrics from Hendershot's checklist to explain why this actually terrifies sophisticated buyers. The danger threshold they use is 20%.
20%.
Yeah. If a single customer represents more than 20% of your total revenue, that is a glaring, flashing red deal killer. The underlying mechanism there is risk concentration.
Okay, break that down for me.
Imagine you have a $10 million company, and one client is responsible for $3 million of that. The buyer isn't just buying a stable revenue stream. They are buying a high-stakes gamble on one single relationship.
Oh,
What happens if that client's new procurement officer decides they want to use their own preferred vendor?
right.
Or what happens if that client gets acquired themselves or just decides they don't like the new ownership of your company? If that one customer departs, it completely changes the economics of the deal. You suddenly don't have enough revenue to cover the overhead or the debt the buyer took on to purchase the company.
Okay, that makes total sense when you frame it around risk. It's a massive structural vulnerability. If that one giant client sneezes, your entire company catches pneumonia.
That's a perfect way to put it.
The buyer isn't acquiring a business. They are acquiring a subcontracting gig for that one client.
Exactly. And speaking of hidden risks, that leads perfectly into legal and compliance exposure. This is another area where familiarity blinds the owner.
Yeah.
What feels like a minor back burner issue to a seller, maybe it's a lingering HR dispute that hasn't escalated, a missing local permit, or handshake deals regarding intellectual property.
Right, things they just ignore.
Yeah, those become a complete deal stopper for a buyer's legal team. Buyers are acquiring your past liabilities. If they find unexploded landmines in your compliance records, they will walk away.
Which brings us to the final deal killer. Unrealistic seller expectations. Yeah, this is the belief that sheer hard work and late nights guarantee a premium valuation. It's the owner believing that buyers should overlook serious operational risks simply because the seller has spent 30 years investing their life into the company.
And the stark reality is that the open market does not care about your sweat equity. It does not care about your personal sacrifices.
It's brutal.
It is. The market only cares about transferability and future cash flows.
Okay, so looking at this entire landscape of deal killers, there is clearly a massive fundamental disconnect happening here. Why do sellers and buyers view these exact same elements of a business so differently?
It's a totally different mindset.
It seems to come down to fundamentally different definitions of the word value.
If we connect this to the bigger picture, the definition of value is completely polarized based on where you are sitting at the table.
Right.
Sellers evaluate their business emotionally. They value the historical revenue, the years of personal sacrifice, the intense loyalty they've built with their staff, and the physical assets they've accumulated.
Because they lived it.
Exactly. Their entire concept of value is looking backward at what it took to get to this exact moment.
But buyers evaluate structurally. They aren't looking backward at your history. They're looking strictly forward.
Yep.
They are asking, is this model scalable? Is the infrastructure transferable to a new team? Are the future earnings highly predictable? Is every core function fully documented?
And the fundamental shift you have to make in your mind as an owner is this. Buyers are not purchasing your history. They are purchasing future operational reliability.
Right.
They are paying for the assurance that the cash machine will continue to print money at the exact same rate or better once the founder is sitting on a beach somewhere.
Here's where it gets really interesting and honestly a bit brutal for the seller. When a buyer finds one of those structural risks we just talked about, say a severe lack of written SOPs or 25% customer concentration, it isn't just a polite critique from their consulting team.
No, not at all.
It has a direct, severe financial mechanism attached to it. Every risk becomes a literal financial discount on the upfront price they're willing to pay. Or even more commonly, it becomes the basis for a punishing earnout structure.
The earnout is a perfect example of how buyers mitigate the exact risks we are discussing.
I want to make sure we clearly explain the mechanism of an earnout, because a lot of owners don't realize how painful they can be.
They really don't.
Say you were expecting a $20 million payout. The buyer finds all these undocumented risks and says, well, we'll give you $12 million in cash today. The remaining $8 million is an earnout.
They hold it back.
Right. They hold that massive chunk of your money hostage. If the business can hit specific, aggressive growth targets over the next 3 years without you steering the ship, you get the rest.
But if you miss the targets.
Exactly. If revenue slips even a little bit because your memory-based processes failed without you here to put out fires, they keep that $8 million.
No.
Your undocumented processes are literally costing you millions of dollars in guaranteed cash at the closing table.
That is the harsh, unvarnished reality of due diligence. The buyer uses the earnout to shift the cost of your operational chaos back onto your shoulders.
Oh,
So the obvious question becomes, if buyers are paying top dollar for future reliability and guaranteed transferability, how do you actually give it to them?
right.
And the answer is you absolutely cannot scramble to do this in 30 days when someone casually makes an offer. You have to build this infrastructure years in advance.
Which brings us to the playbook. The source material outlines 5 actionable steps to bulletproof the future of the business. Let's get into how you actually fix this stuff and upgrade the engine.
Let's do it.
Step 1 is upgrading the financial engine, which means getting financial clarity.
This requires graduating from whatever ad hoc cash basis bookkeeping you've been doing for years and getting CPA prepared accrual basis financials.
Let's break that down because accrual basis is one of those terms that gets thrown around in boardrooms, but it drastically changes the picture of a business compared to cash basis accounting.
Oh, it changes everything about how a buyer views your profitability.
How so?
Well, cash basis accounting is simple. You record income when the cash actually hits your bank account, and you record expenses when you pay the bill.
Which sounds totally logical.
Right, but that creates massive distortions. If you pay an annual software license of $120,000 in January, your January profit looks terrible.
Oh, right.
Accrual accounting, on the other hand, matches revenues to the specific expenses incurred to generate them. So that software expense is divided and recorded as $10,000 a month over the whole year.
God.
Accrual accounting strips away the distortions and gives buyers a true, realistic picture of the company's financial rhythm and health.
And part of that financial clarity is documenting all of your add-backs clearly. If you are running personal expenses through the business your car lease, a family member on payroll, country club dues.
Which many private owners do.
Right, they all do it. But you need an ironclad documented paper trail. You have to prove those are discretionary expenses so the buyer can confidently add that cash flow back into the overall valuation.
Exactly.
Your internal management numbers in your tax returns have to tell the exact same story without any creative interpretation.
Moving to the second actionable step, we have to tackle the hardest psychological hurdle for an entrepreneur, extracting the founder.
Yeah.
You have to intentionally reduce owner dependency and transfer those key relationships away from yourself.
So if my memory-based process and my personal client relationships are terrifying the buyer, how do I practically extract my brain from the center of this business?
It's not easy.
The source material poses an ultimate litmus test for the listener, and it is an absolute gut punch.
Let's hear it.
Here is the test. Could your business operate for 30 days without you? Not just survive on life support while everyone panics, but actually operate, fulfill orders, and generate revenue.
Yeah, and for the vast majority of founders, the honest answer is no.
Right. And I have to push back on this because I can hear founders screaming at their speakers right now.
I'm sure they are.
They're saying, if I leave for 30 days, my inbox will have 4,000 unread emails, my biggest clients will be demanding to speak with me, and payroll might not even run correctly.
Excellent.
How can an owner possibly step away for 30 days without the business burning to the ground?
The harsh truth is, if the business burns to the ground when you leave, you don't actually own a business. You own a very high-paying, incredibly high-stress job.
Ouch.
To fix that, you move to the third step, documenting core operations. You cannot step away until you extract your knowledge and turn it into written standard operating procedures, or SOPs, for every single critical workflow.
Like, how do we onboard a client?
Exactly.
How do we handle a supply chain delay? Who has the authority to sign checks?
It's about empowering your managers to actually lead, rather than just acting as messengers for your decisions.
And part of that documentation is building a secure data room long before you ever intend to sell. A data room is a centralized, highly organized digital vault containing all your vendor contracts, employee agreements, corporate records, and SOPs.
It's a game changer.
Imagine the immense psychological advantage of a buyer asking a difficult question about your processes, and instead of saying, "Let me get back to you," you immediately hand them access to a fully indexed, comprehensive data room.
Their posture completely changes. The buyer's confidence skyrockets because you have proactively eliminated the uncertainty. You've proven that the business runs on systems, not on the founder's heroics.
Which leads right into step 4, systemizing compliance and organizing records early. You have to conduct your own internal legal audit before a buyer's aggressive legal team does it for you.
A massive, incredibly common trap here is employee classification.
Oh, yeah.
Are you absolutely certain you are compliant with the regulations separating W-2 employees from 1099 independent contractors?
A lot of people mess that up.
They do. Because if a buyer discovers you've been misclassifying workers to save on payroll taxes, they see a massive retroactive lawsuit waiting to happen, and the deal dies instantly. You need to gather 3 or more years of flawless financial, legal, and HR records so there are absolutely no gaps in the story.
The overarching theme across all of these solutions is what Hendershot calls the most critical mindset shift an entrepreneur can make. You must relentlessly view your business through the eyes of a cynical buyer.
A cynical buyer, that's key.
Right, you have to ask yourself every day, what would concern an outside, unemotional investor? Where does uncertainty exist to my operation?
Taking on that mindset fundamentally changes how you operate, because suddenly you aren't just running a company day to day, you are actively building an asset.
Exactly.
You are transitioning from being a frantic operator to being a true owner. An operator is perpetually bogged down in the daily survival of the business. An owner is designing an elegant, resilient system that can function, scale, and eventually be transferred entirely independent of their daily effort.
So what does this all mean for you, the listener? We've covered a tremendous amount of ground. We've explored the harsh realities of due diligence and how buyers aggressively validate reality.
We covered a lot.
We've seen how the 8 deal killers, from the founder's trap to customer concentration, compel buyers to walk away. And we've seen how you have to upgrade your financial engine and extract yourself from the center of the chaos.
Ultimately, it means that navigating due diligence isn't about hiding your flaws, playing defense, or trying to put lipstick on a pig during the final hours of a deal.
Right.
It's about fundamentally changing how your business is structured long before you ever sit down at that mahogany table to sign a letter of intent. It's about building a sound, transferable machine.
I want to leave you with one final provocative thought. We've spent this entire deep dive talking about preparing for a sale, pleasing a buyer, and surviving forensic due diligence. But let's zoom out.
Okay.
Let's say you love what you do. Let's say you have absolutely zero intention of ever selling your business. You want to run it until the day you retire or pass it down to your kids.
Sure.
Wouldn't building a company that can pass a buyer's intense due diligence, a company with documented processes, truly empowered managers who don't need your permission to solve problems, meticulously clean financials, and absolutely no daily firefighting, wouldn't that just make your life as an owner infinitely better right now?
It absolutely would. You don't have to sell your business to reap the rewards of this process. The peace of mind that comes from having a truly transferable, self-sustaining operation is invaluable, whether you sell tomorrow or hold on to it forever.
Exactly. You do the hard, unglamorous work of building the systems today, you face operational reality before a buyer forces you to, and then you don't have to wait for an LOI to pop the champagne. You can enjoy the freedom of owning a real business right now. Thanks for joining us on this deep dive. We'll see you next time.